Hello everybody and welcome to a new valuation video. So in today's video, no investment advice of course, but I wanted to talk about growth stocks, mega cap growth stocks, and how those are valued. And before I go into the valuation, I'm doing this a little differently from most other people who analyze stocks who use PEs and stuff like that. I do it somewhat differently because I look at growth and I'm mostly interested at high growth stocks and stocks that will actually compound at very high rates of return, say 30% plus. So what are some of the assumptions in the analysis I'm making in this video? So one of those assumptions is that I treat all of these mega cap tech stocks as if they were only optimized for gross margin. Now I know full well that Apple is well optimized for buybacks and earnings, etc. But I am judging these companies as if they were optimized for gross margin because that's kind of a main way I assess all stocks on this channel, and so I think it's important to keep a little consistency. I assume that management will reinvest selling expenses, general and administration expenses. I assume that they'll R&D. I assume that they'll reinvest it wisely. And it would be a bold assumption to make for a lot of stocks. But for these 7 stocks, I don't think it's a bold assumption to make. These companies have been outstanding capital allocators, outstanding returns for at least the past 10 years for these companies. So I don't think it's a problem to assume that here, but it's still a bold assumption. So I assume that they're going to do well. Everything in the income statement after gross margin, I assume that they are going to follow their fiduciary duty and spend it wisely towards the growth of the firm. And then the last assumption that I'm making is that if there is a mega tech stock which has similar characteristics in terms of revenue growth over gross margin, in terms of enterprise value over gross margin. If we have these same characteristics in a mega cap stock, then I'm assuming that it's better than buying a mid cap or a small cap stock, because if we have these same very, very high growth characteristics, you're still getting something that is in theory only, but in theory, it's less volatile. In theory, you have fewer takeover risks to worry about, and you have fewer unknown issues. Like if you take a company, for example, like Tesla or Google, Apple, Amazon, these companies are highly scrutinized by the market, and so there's fewer risks that they've hidden something, and there's fewer risks of fraud, and there's fewer risk of volatility because these companies are in the indices. So the indices really help stabilize. In theory, I say in theory because in practice, we've both had Tesla and Meta that I've had to have 70% drawdown, but the market has been crazy. But so these are the assumptions that I'm making. So now with these assumptions in mind, let me show you my valuation for these stocks and my ranking for these stocks. So feel free to pause on this slide if you want to see the different things that I've made. But let me briefly walk you through the slide. So first of all, you have the ticker symbols, right? Enterprise value. I say enterprise value because I want to take into account whether they have debt or not. So it's market cap plus net debt. And, I want to penalize a company that has too much debt. So that is why I take enterprise value. Revenue, right? Trailing 12 months. Revenue growth, and I'm using a conservative estimate of revenue growth for all of these. And so this is kind of where the argument against a model or for valuation lies. It's like people are just arguing about revenue growth. I think these are fairly conservative assumptions for revenue growth for all these 7 companies. Then I take gross margin. So again, that's the latest gross margin. Gross margin could move up in the right direction as these companies get more efficient, but I don't assume any increase in gross margin. And so that gives you a gross profit, and then forward gross profit, right, for next year. And then based from that, I have my valuation metrics. So one of them is enterprise value over trailing 12-month gross profit. And remember the assumption that I made in the last slide. Then enterprise value over forward gross profit. And then I have this one, which is enterprise value over 12-month gross profit to revenue growth. And so let me just provide a little explanation here of that metric. And this is kind of my take of a modified PEG ratio. So I want to give more credit to companies that grow much faster. So for each percentage point of growth, I want to have more credit given to that company, which is why I kind of modified the PEG ratio with using the trailing 12-month gross profit instead of earnings, right? So in Peter Lynch's ratio, the PEG ratio, very famous ratio, he uses earnings, and I decided to replace that with gross profit. And my rationale for doing that is that many growth stocks nowadays reinvest everything in the business, especially those mega cap companies. They reinvest everything in the business. Thus, earnings are not always the priority, and they're not always relevant. And these companies have strong incentives to not have very, very high earnings. And I mean, the best proof of that is Amazon, right? Amazon is doing everything it can to not show earnings in the way it invest and reinvest in the business. And I would argue it is the same to an extent for most of these companies. So I don't think it makes sense to use earnings. I think it makes sense to use gross profits. Peter Lynch's idea of a PEG is simply to say, well, if you have a 20 times earnings price to earnings ratio, and the company grows at 20 times points, so 20 percentage points grows its earnings at this speed, then you have a PEG, a PEG ratio of 1, and that's considered fairly valued. And anything under 1 is undervalued. And my version of that, of course, has to be a little more stringent because gross profit is not free cash flow. It's not the bottom line, right? So I have to be just a tad more stringent. But my variation is 20 times enterprise value over gross profit is fair for a firm whose revenue growth is 40%. So revenue growth has to be at least twice as high as the EV to trailing 12-month gross profit multiple for the company to be fairly priced. And so that means that any EV to TTM GP to revenue growth ratio that is under 0.5 would be undervalued per my framework. And so that places Tesla, that places Google, and that places Amazon well into the undervalued category per my calculation. I realize it's just my metric, but I really want to give credit to revenue growth because over the long term, revenue growth is what matters. And these companies have been good stewards of shareholders' money, and I trust that they really will reinvest wisely the money that they earn beyond their gross margins. So I trust that. And so when I look at my ranking here, well, what is my ranking? Well, quite simply, my ranking is Tesla number 1, Google number 2, and Amazon number 3. And if I were to just look at the value lens, the ranking would be Amazon number 1, Google number 2, and Tesla number 3. And this is summarized right here. And if we were to actually merge my ranking, right, with the value ranking, which I think is just the metric speaking versus what I'm saying, and what I'm saying, by the way, is mostly based on these growth rates, right? I think a 50% growth rate for a company that large is absolutely unheard of. You know, if you see companies like Apple or Meta, these companies are not growing fast at all. I mean, even Amazon or Microsoft are not predicted to grow as much as monetary inflation. So again, low growth, more value stocks. But if I were to mix all of those three, right, the 3 + 1 = 4, 2 + 2 = 4, 1 + 3 = 4, I'm getting to an ex-equal rank. So what that means essentially is that by merging both of my metrics, I could argue that Tesla, Google, and Amazon are all equally good buys right now at these prices. And that is kind of a conclusion of this video. No investment advice, of course, but if one is to invest in big tech and wants to invest in big tech and focus on big tech, really a mix of Tesla, Google, and Amazon are the companies that I think will perform the best going forward based on these metrics. And feel free to pause, feel free to agree or disagree. I realize this is a little unconventional, but I hope you like the video. This is just entertainment, not investment advice. It takes me a lot of time to make these videos, so if you can like and subscribe, I really appreciate it. Thank you very much and have a great day.